Something is building quietly in the background of global markets, and most people aren't paying attention. Yet the signs are right there, hiding in plain sight. Gold, an asset many investors forgot about during years of easy money and soaring stocks, is beginning to move for reasons far deeper than headlines or hype. And if the current pressures keep pushing the way they are, gold may rise in a way that surprises even the people who already believe in it. Now, I've spent my entire life studying how money behaves under stress. I've watched currencies weaken, markets swing, and interest rates climb far faster than anyone expected. When you've lived through enough cycles, you start to notice when something isn't normal. And what's happening right now with debt, inflation, and global uncertainty is anything but normal. Before we dig into what could send gold higher than anyone imagines, I want to make one thing clear. This isn't fear. This isn't panic. This is observation. Numbers tell stories, and the story forming around gold today looks very similar to the early stages of past long-term surges. Every major gold move in history began the same way, slowly, quietly, almost politely. And then suddenly, one day, it wasn't quiet anymore. What's different now is that the pressure behind gold is coming from several directions at once. You have rising government debt, higher borrowing costs, growing currency tension, shrinking trust among nations, and a global economy that looks far more fragile than the optimistic forecasts suggest. It feels like we're entering a period where people and institutions are starting to look for something solid again, something they can hold, something that doesn't depend on political promises, central bank decisions, or fragile systems built on leverage. That, my friends, is where gold tends to shine. Let's start with one of the biggest drivers of gold's next chapter: debt. We live in a time when government borrowing is climbing at a pace nobody used to think was possible. When interest rates were near zero, the cost of carrying that debt barely mattered. Money was cheap, borrowing was easy, budgets seemed painless. But we no longer live in that world. Rates are higher, carrying costs are heavier, and the world is discovering what happens when decades of rising debt collide with rising interest expenses. When debt grows faster than income, something eventually has to adjust. Governments can raise taxes, cut spending, borrow more, print more, or watch their currency weaken. None of these outcomes are pleasant, and all of them tend to push investors towards safer ground. That's when gold starts entering the conversation, not as speculation, but as insurance. Another driver is global tension. Countries are no longer cooperating the way they once did. Nations that used to trust each other with trade, resources, and reserves now question that trust. When trust declines, currencies suffer. And when currencies suffer, gold becomes a natural alternative. Gold doesn't care who's in office. Gold doesn't respond to sanctions. Gold doesn't freeze in a bank somewhere because two governments disagree. It simply sits there, unchanged, doing exactly what it has done for thousands of years. One of the strongest reasons I believe gold may surge comes from watching how other major economies are reacting. Many nations have been increasing their gold reserves quietly, steadily, without drawing much attention. They're not buying gold for entertainment. They're buying it because they see a world where currency risk is rising. When global leaders start shifting into gold, that should tell everyday investors something important. They're getting ready for a future where they want less exposure to promises and more exposure to certainty. But let's zoom into something even more interesting: interest rates. For years, low rates kept gold from climbing too quickly. Investors preferred stocks, tech companies, and high-growth opportunities. But when rates rise, borrowing becomes expensive, valuations compress. People start looking for assets that don't require perfect conditions to maintain their value. Gold becomes attractive because it doesn't owe anything, it doesn't need cash flow, and it doesn't depend on a good economy to justify its price. The world spent more than a decade getting used to cheap money. Now it must unlearn that habit. And anytime the world goes through a reset in expectations, gold tends to find new momentum. There is also something psychological at play. People flock to gold not just because of numbers, but because of comfort. Gold represents safety when things feel uncertain. And right now, investors around the world are starting to realize that uncertainty is not a temporary visitor. It's becoming a permanent resident in modern markets. Whether it's political instability, supply chain issues, competitive tensions, or unpredictable global events, the appetite for safety is growing, and gold has always represented safety. Yet the most powerful force behind gold's potential surge isn't fear, it's math. Debt rising faster than income cannot continue forever. Currency supply rising faster than productivity cannot continue forever. Interest payments growing faster than government revenue cannot continue forever. These are mathematical realities, and whenever a system stretches too far, people instinctively turn to something stable, something predictable, something proven. Gold fits that description perfectly. Now, let me address something many people misunderstand. Gold doesn't rise because the world is falling apart. It rises because people lose confidence in the systems meant to hold everything together. Gold rises during inflation, during market stress, during currency declines, and during debt expansions. It rises when people start doubting whether the financial rules they've relied on will keep working the way they used to. And today, more people are questioning those rules. Another reason gold may surge like never before is the shift in global power. Nations that once held mostly United States dollars are now spreading their reserves into other currencies, commodities, and gold. This diversification isn't a trend, it's a structural move. And structural moves usually last for years. When governments reduce their reliance on a single currency, gold almost always benefits. The most interesting part is that ordinary investors haven't fully woken up to this trend yet. Gold is still treated like an afterthought by many. They chase the latest stock craze, crypto boom, or high-risk opportunity without realizing that large institutions are quietly preparing for a world where safety and reliability matter more than excitement. When the public eventually sees gold moving sharply, they'll rush in. But by then, the early advantage will already belong to those who paid attention now. What makes this moment even more compelling is how little gold many portfolios actually hold. During the era of cheap money, investors pushed gold aside, believing stocks and innovation were enough to protect them. But markets move in cycles. When one cycle ends, another begins. It feels like the world is closing the chapter on cheap money and opening a new chapter, one defined by higher rates, heavier debt, and deeper uncertainty. In that environment, gold tends to rise not gradually, but powerfully. I'm not saying gold replaces stocks. I'm not saying gold becomes the only asset worth holding. But in times like these, gold becomes an anchor, something steady in a sea of volatility. And when enough investors look for that anchor all at once, the demand can push prices to levels far beyond what anyone predicted. Everything I've observed tells me one thing: gold is preparing for a moment that has been building for years. And if this moment continues to unfold, the movement could be bigger than anything we've seen in modern times. Gold's momentum also grows from something people often overlook: faith in long-term purchasing power. Every currency in the world loses strength over time, some faster than others, but gold holds steady across generations. When people sense pressure building beneath the financial system, they start comparing what money buys today to what it bought a decade ago, and that realization becomes a quiet force pushing demand toward gold. It's not loud, it's not dramatic, it's simply a recognition that stability has a price, and gold tends to provide that stability when nothing else feels certain. What makes the current moment different is how many separate pressures are forming at the same time. Higher borrowing costs are squeezing governments and corporations. Households are feeling the strain of rising expenses. Banks are tightening lending because they don't want to take unnecessary risks. These conditions create a world where even small disruptions can ripple across markets. And in a world built on confidence, even slight cracks can make people nervous enough to seek something more dependable. Gold thrives in moments when confidence wobbles, not collapses, wobbles. Because when confidence collapses, panic spreads too fast. But when confidence wavers slowly, people adjust their behavior in a measured way. Institutions begin increasing their gold reserves quietly. Investors begin adding small positions. Families look for safer places to store savings. These steady shifts build momentum long before the public notices anything unusual. Another overlooked driver is the decline in trust between nations. Countries that once depended on each other for trade, financing, and currency stability now operate with more caution. Even allies hesitate in ways they didn't before. This shift pushes governments to diversify their reserves so they aren't caught off guard if global relationships change again. Gold becomes the simplest solution because it removes the need to trust another country's policies. At the same time, technology has changed how quickly information spreads. Investors react faster, institutions reposition quicker, and markets move in ways that would have been unthinkable 20 years ago. When gold starts climbing in an environment like this, momentum can build at remarkable speed. People begin chasing safety all at once, pushing prices higher, not just because demand rises, but because fear of missing out adds fuel to the movement. What makes gold uniquely powerful is that it doesn't depend on perfect conditions. It doesn't require strong economic growth. It doesn't need low rates. It doesn't rely on earnings reports or innovation cycles. Gold simply waits for the world to remind itself that stability matters. And when the world remembers, gold responds. Everything happening right now, rising debt costs, shifting global alliances, currency pressure, and growing caution, creates the kind of environment where gold can move faster and farther than anyone expects. The most important factor behind gold's potential rise is how investors respond when uncertainty grows louder than optimism. People aren't drawn to gold because they expect the world to fall apart. They're drawn to it because they sense that the systems they rely on may not operate as smoothly as they once did. When rates stay high, when debt expands faster than growth, when currencies weaken under the weight of long-term pressure, people begin looking for an anchor. Gold fills that role naturally, without asking for confidence in any institution. Strength in gold often comes from quiet decisions made long before the price moves sharply. Large holders accumulate during calm periods, not during headlines. They recognize that long-term protection matters more than short-term excitement. As more institutions position themselves this way, the foundation for a significant move forms beneath the surface. It doesn't look dramatic until the final stage, but by then the groundwork has already been laid. Another force pushing gold forward is the simple reality that many assets today depend heavily on low borrowing costs. When those costs rise, weaker parts of the financial system begin to strain. Companies built on debt find it harder to grow. Households feel stretched. In times like these, investors rethink where they want their money to sit. The desire for something steady grows stronger, and gold benefits from that shift in mindset. Gold also rises when people begin questioning the long-term direction of their currency. If someone believes the dollars they hold today will buy less tomorrow, they look for an alternative. Gold has always answered that need because it outlasts political cycles, interest rate decisions, and market phases. It holds its identity across generations. What makes this moment so compelling is the combination of long-term pressures building alongside short-term doubts. Inflation didn't disappear, debt didn't shrink, rates didn't fall back to where they once were, and global cooperation didn't strengthen. These conditions don't guarantee a major movement in gold, but they create an environment that supports one. The smartest investors prepare before the rush. They add stability to their portfolios before volatility forces their hand. They focus on strength, patience, and durability rather than reacting to every headline. Gold fits that mindset because it reminds investors that sometimes the best assets are the ones that don't try to impress you, they simply endure. If the world continues along its current path, gold may not just rise, it may redefine how people think about safety in a modern financial system.